Okay, students, before we start the revision of risk management, that is Forex, one message to everyone, that is including myself as well. What is that? Actually, I would say not a single individual can grow if we stay in our comfort zone. So if you really want to grow, if you really want to achieve something, so we have to work in our uncomfortable zone. Sometime obviously what happens that when the exam obviously comes nearer and nearer, it's natural the student they get stressed out. It's natural. When I was a student, so it was happening with me as well. It's natural. But the main thing is, instead of delaying the attempt, the main thing is you have to attempt the paper. If, right now, you should be attempting the paper in March 25 and clear it out. So you just need to know one thing. In a comfort zone, we cannot grow. And one more thing, the sooner, the earlier you will complete your qualification, you become an ACCA affiliate, is better for you. Because due to getting this qualification, delay, let's say something which can be achieved in 3 months, if you're going to achieve in 6 months, 1 year, you have to bear the opportunity cost as well. Sometimes it happens that you have the complete practical experience, but due to not having the full qualification, you don't get paid what actually you deserve. And one more thing, then we start the class. See, every day, every person gets busier and busier in their lives. That's again natural. So at least I would say try to complete the chapter of your qualification as soon as possible. So always do not give second option to your brain regarding that I can delay the attempt. No, never give this option. Tell your brain, no, I have to attempt and I have to pass as well. So that's a simple message I wanted to give to everyone, including myself as well, obviously. If we need to be comfortable in an uncomfortable zone, then we can achieve many things. So let's try to be comfortable in uncomfortable zone. Then you will be comfortable. Okay. Let's just start student Forex. Obviously, extremely, I would say, important area of our syllabus. There's no doubt about it. And this risk management is having two parts. Inshallah. This risk management is having two parts. One is risk management relating to the currency risk, and another is interest rate hedges. In today's class, we'll be revising almost each and every concept of risk management regarding currency risk. Then the next class will be on interest rate hedges. Okay. And plus, either today, otherwise in the next class, I'll announce something new in AFM, and inshallah that will increase our passing rate. So that will be really good also. So I'm thinking to do something good more. No, no, no. See, attempting the test and getting stuck, again, I would say you are in a learning process. It's a learning process. It's a learning process. So please, again, attempting the test, getting stuck, again, you are just in a learning process. So don't get upset from that. You have attempted the test, that is itself a really good thing, because there are a number of students, we do share them the test, but they don't attempt it. So if you have attempted, so itself it's a really good milestone which you have achieved. Okay, students, Forex risk management. Number one, currency risk. There are three types of currency risk. Types of currency risk. One is transaction risk. Transaction risk is a short-term risk. Short-term means the time period is less than equal to 12 months. A very basic understanding of transaction risk is a short-term risk. When I say short-term, the time period is less than equal to 12 months. What is the example of transaction risk? For example, due to import, you have to make payment within 12 months. You will be facing a transaction risk. On export, you are receiving amount of foreign exchange within 12 months. You are facing transaction risk. In fact, those students, they are not in UK and they are not earning in pound sterling. So obviously we face transaction risk, because when you will be making payment to ACCA, you have to bear this transaction risk. Another point is, in case of transaction risk, if there's a gain or loss, that gain or loss will be in terms of cash. How do we hedge transaction risk? So basically almost every hedging strategy which we are going to discuss today, that will relate to the risk management of transaction risk. Don't worry at all. The second is translation risk. Translation risk is a long-term risk. When we say long-term, it means more than 12 months. Obviously, when you say more than 12 months, then there is no time period, because you're saying more than 12 months. Then it could be any time period. Okay, now, when we say translation risk, number one, it's a long-term risk. Second, translation risk organizations, they face due to strict accounting standards. Another example. Now, the best example of translation risk is in case of a foreign subsidiary. When we consolidate the books, obviously I have to convert subsidiaries financial statements which are, let's say, in dollars, and parent is in UK. So before doing the consolidation, I have to translate my subsidiaries books. I need to convert them from dollar to pound sterling. So while converting subsidiaries books from dollar to pound sterling, obviously the net asset, they can increase, they can reduce. It means I'm facing translation risk. But either there's a translation gain or translation loss, that will be a gain or loss within the books. It will not be in terms of cash. How do we hedge translation risk? There's only one way to hedge translation risk. What is that? If foreign exchange asset, they're equal to foreign exchange liabilities, then you will not be facing translation risk. And obviously it's not possible to achieve, but if you can achieve this on any transaction, then you are not facing any translation risk. But the best example for the translation risk is foreign subsidiary. Then obviously group faces translation risk. Third, economic exposure risk. It's a long-term risk, number one. Number two, there are two situations in which company faces economic exposure risk. Number one is when home currency, basically I'm talking about local currency, gets strengthened, means getting strong. Now try to understand. If your local currency, your home currency gets stronger and stronger against the foreign exchange, you will be facing economic exposure risk. The question is how? Let me explain. Basically, when your local currency gets stronger and stronger, strengthen and strengthen, then it discourages the export. Why it discourages the export? Because your currency is getting very, very strong. Okay. When your currency is getting stronger, so can I say when I'm going to receive the foreign exchange, when I'll be converting that foreign exchange into my local currency, I will not get a big amount. I'll get a very small amount. So basically, when your home currency starts getting stronger, one, it discourages the export, and there's a second issue also very important. What is that? For you, it is an export, and obviously, for foreigners, that is an import. When your currency starts getting stronger, then import from your country, import from your country becomes very expensive for them. Now, due to this, what happens? There is a greater chance that you will start losing the export, you will start losing the sales. Why I'm losing my sales? Because my currency is becoming stronger and stronger, and it is becoming expensive for other countries to import from my country. So this is the one way that I'm facing this economic exposure risk. Now the question is how to manage this risk. This is very important. Now listen. Why other countries they're not giving you order now, or why they have dropped the orders, why they have reduced their orders? Because your currency has become stronger, and it has become expensive for them to purchase goods from your country. How to hedge this? There are two ways to hedge this scenario. One, try to reduce your production cost. Try to reduce your production cost. Obviously, if you can reduce the production cost, then you can sell your price at you can sell your products at a competitive price. Which company can reduce the production cost? Only that company can reduce the production cost, which is a diversified company which has, let's say, production facilities in number of countries. And obviously, when you have production facilities in number of countries, then you can find out where you can have a lower production cost. Let's say if you are unable to reduce the production cost, then what to do? Still, you can manage this risk by branding. One was try to reduce your production cost. Try to reduce your production cost. Another is branding. Your marketing department has to play a key role for regarding the branding. Can I say when the brand is, made, then don't worry at all. People will pay you whatever you are asking. The best example of this branding is, I would say, universities in UK, USA, Australia. Their fees are sky high, not normal high, they're sky high. But still, I would say you will find number of students, and I would say almost 95% of the students, they are from the developing countries. You will hardly see any local studying in UK in universities. No, they don't study so much. You will find 95% people from rest of the world. So still they are paying such a heavy fees. Why? Branding. They know that if we can study in that university, so we have a good future. So two ways to deal with this economic exposure is: one, try to reduce your production cost. Second, branding. There's another scenario in which we face economic exposure risk. That is, Foreign direct investment, FDI. In case of foreign investment appraisal, we also face economic exposure risk. How? For example, the project is having a useful life of 4 years. Okay. Project is having a useful life of 4 years. Let's say these are the net cash flows in dollars, whatever they are. And we have to convert them in pound sterling because the investor is in UK. Spot rate, okay, I know that. But obviously, for the next 4 years, normally we use purchasing power parity to predict future exchange rates. Can I say whatever exchange rates we have calculated by using purchasing power parity or by using appreciating or depreciating currencies? And I think I said many times that interest rate parity is not used to predict future exchange rate for a longer period of time. Logically, interest rate parity is used by the banks to calculate forward rate. So when it comes to the prediction of future exchange rates for a longer period of time, either I'll go for purchasing power parity or appreciating or depreciating currencies. Now listen, by using purchasing power parity, can I say whatever exchange rates we have predicted, we have calculated, and let's say we have used in our foreign direct investment appraisal. Can I say when the actual time comes, your actual rate, they will be different than what you have predicted. It means that whatever NPV we have calculated, actual NPV is going to be different because of the exchange rates. So that is another second scenario in which we are facing economic exposure risk. Now, how to hedge this risk? When I'm facing economic exposure risk in case of foreign direct investment, there is only one way to hedge this. The name is currency swap. Basically, in currency swap, what happens? Exchange rate becomes fixed for a longer period of time. Example. Here we have predicted, first we have predicted exchange rates for T1, T2, T3, T4 by using purchasing power parity. Now in currency swap, what happens? Let's say your company is ABC company and there's a bank. There will be an agreement between your company and bank. And in that agreement will be regarding currency swap. And bank will give you the exchange rate for the next 4 years. And for those next 4 years, whatever exchange rate banks give you, there will be an agreement, which means that now you'll be using the exchange rates which you have received due to this currency swap agreement with the bank. So now, practically, whatever happens, practically, when the time comes, your actual rate is going to be different, but that rate will not disturb you. Why? Because under a currency swap, exchange rates are fixed for you. So instead of using the exchange rate by utilizing purchasing power parity, if I get exchange rates by currency swap, then I'm not facing this economic exposure risk. So let me repeat. In case of FDI, we face economic exposure risk, but there's only one way to hedge, that is currency swap. And please learn one more thing. Currency swap is the financial product which is used to hedge for a longer period of time. And currency swap we use for economic exposure risk. It means other than currency swap, whatever technique we'll be studying today, that will be for transaction risk. And we know that transaction risk is a short-term risk. So economic exposure risk is a long-term risk, and for this long-term risk, we use currency swap for hedging. Now, translation rules. Okay, before I just discuss the translation rules, have you people seen the lecture of, I think, I forgot the name of a question regarding investment appraisal, which I uploaded in the previous week. Mackie, they were like that I recorded within 35 minutes. Have you people seen that? Yes or no? That is also in the live revision folder. Can you quickly reply, students? Mackie, Deaver, something like that. One student has seen, what about others? Only one? Yeah, Mackie Word Company. Yes, one more, that's great. Because I went for I would say the video debrief of that question. I think within 35 minutes, I counted the time as well. Within 35 minutes, almost each and everything regarding the question I've explained. The whole objective was in a very short period of time, I'll give you the complete idea of the question because no, there wasn't a point of going for 2 hours or 3 hours. Nobody watches that much long lecture. So within 35 minutes, I explain almost each and everything. So please, those students that have not seen, go through that question as well. Okay, now translation rules. How do we translate foreign currency and let's say when it comes to translation rules, their number one rule is direct quote. Direct quote. How will you find out that given quote is a direct quote? Please look at this. In the numerator, there will be local currency. Denominator, there will be a foreign currency. Rule of translation is multiplication. We multiply in order to translate. And let me tell you one thing, students, do not make mistake in translation because this is not a tolerable mistake by the marker. Okay. For example, we are working for ABC company. Assuming ABC company is a Pakistan-based company. So it's a Pakistan-based company, then home currency is PKR. Spot rate means today's exchange rate. Let's say rupees per dollar. We are working for ABC company. ABC company is a Pakistan-based company, so rupees per dollar. Home currency upon foreign currency is a direct quote. There are two exchange rates, let's say 278 and 280. Now we need to decide which one is a buying rate, which one is a selling rate. Number one. Number two, please listen to me carefully. One student, he asked the question as well, I think yesterday or the day before yesterday. Listen carefully. There are two exchange rates, 278 and 280. Direct quote, we sell low. This is your selling rate. We buy high. This is your buying rate. And let me tell you, when I'm writing, this is your selling rate, this is your buying rate, I'm talking about you. I'm talking about myself. I'm talking about a company for which we are doing hedging. I'm not writing these rules for the money exchanger. Money exchanger is not doing the hedging. Me and you, and let's say ABC company, we are doing the hedging. So is this clear? Whenever I give you the concept that this is my buying rate, this is my selling rate, we are talking about ourselves. We are not talking about the money exchanger. I hope it is now clear. We sell low, we buy high. And logically, what is the logic behind this? The logic is very simple. The exchange rate in which you have a loss, that belongs to you. You are having a dollars, but you cannot get 280 from the money exchanger. You will be getting 278. You want to buy the dollars from the money exchanger, even though there are two rates, 278 and 280, but still you have to pay 280. So please always remember, direct quote, we buy high, we sell low. And I'm talking about you and me, I'm talking about ABC company for which we'll be doing hedging. Now, there's an indirect quote as well. Foreign currency upon home currency. In case of an indirect quote, the rule of translation is division. We divide. Now, spot rate. Let's say dollar per pound is selling 1.72, 1.74. Indirect quote, we buy low. Buying rate. We sell high, selling rate. Again, I'm talking about you and me. I'm talking about a company for which we are doing hedging. For example, ABC company is a UK based company. Obviously, if ABC company is a UK based company, then the local currency is the pound sterling. Let's say they need to pay $1,000. Can I say if they are having a payment of $1,000 and let's say they want to pay someone $1,000. So what happens? They will buy $1,000 from the money exchanger by giving pound sterling. In this way, they can make the payment of $1,000. But they want to buy 1,000. Can I say if ABC company wants to buy $1,000 from the money exchanger and these are the exchange rates, we have decided lower rate is our buying rate. Let's see. Payment in pound sterling. What will be the payment? Can I say 1,000 divided by 1.72? 1,000 divided by 1.72. Students, I'm getting, let's say, 581. Point, let's leave that. Now listen the interpretation. ABC company, which is a UK based company, they have to make $1,000 payment today. Let's say someone from the company goes to the money exchanger. Logically, company can make $1,000 payment by paying 581 pound sterling, or you can say that by giving 581 pound sterling to the money exchanger, company can get $1,000. Now, compare this. Assuming today company is having a receipts of $1,000. Obviously, ABC company is a UK based company, and I have to convert this 1,000 into pound sterling. Let's see receipts in pound, how much? I'm selling this $1,000 to the money exchanger at 1.74. I'm getting 574.7, make it 575. Please check. When the company bought $1,000, when there was a payment of $1,000, company ended up by paying 581 pound sterling to the money exchanger. In case of receipt of $1,000, company ended up by receiving 575 pounds from the money exchanger. So I think it can be seen again. What is the logic behind this? That in case of indirect quote, we buy low and we sell high. The exchange rate logically in which you have a loss that belongs to you. and I'm repeating it again, all the rules of buying, selling, which I'm explaining you, which I have explained in my all the lectures, they are for you, for me, for the company for which we are doing hedging. These are not the rules for money exchanger, because for the money exchanger the rule becomes opposite, and there's no need to go into that because we are doing hedging. Okay, I hope it is clear to everyone. Buying, selling rate, the logic behind that, please quickly reply, students. Okay, that's great. It is quite clear now. One more thing, which I've not seen in the recent past paper, but you should know that also. What is that? For example, spot rate, dollar per pound is selling. If it is 1.72, but plus minus 0.02. Don't go into that much technical details. If it is plus minus 0.02, just do one thing. If I deduct, I'll get 1.70. If I add, I'll get 1.74. Okay. Let's say we are working for ABC company, which is a UK based company. I'm working for ABC company, which is a UK based company. That's it. Buying rate, selling rate. Because it is an indirect quote. Why we are saying indirect quote? Because we are working for an ABC company, which is a UK based company, and obviously for them, local currency is the pound sterling. So this is how we deal with this plus minus. So never forget, indirect quote, we buy low, we sell high. Now, if ABC company is a Pakistan based company, then local currency is PKR. Examiner gives us the spot rate, rupees per dollar. Let's say 278 plus minus 2. Remember, now I'm working for ABC company, which is a Pakistan based company, and that's a direct quote. If I deduct, I'll get 276. If I add, I'll get 280. Repeat, ABC company is a Pakistan based company. PKR, rupees is the local currency. The code is a direct code because rupees upon dollar. So this is now 276 my selling rate, and this is my, because of the direct code. Direct code, we buy high, we sell low. Okay, now transaction risk management. The one technique is forward contract. Forward rate hedge. Forward contract is an OTC product. OTC product means over the counter product. Over the counter product means which is available from banks. Now listen carefully. OTC products are tailor-made products. They are customized products for you. That is why in OTC products, you will not have any underhedge or overhedge issue. Why? Because they are customized for you. They are tailor-made. You will not have any underhedge issue, overhedge issue. You will not have any mismatch of the maturity as well. Because something which is tailor-made, it means it is customized for you. Now, I want to say something. Please listen carefully. If examiner gives you OTC currency options. Number one, whenever my examiner says OTC currency options are there, it means that traded options are not there. That is why examiner is mentioning OTC option. Student, I want an answer, okay? Let's say we are a company, we need to do hedging. Assuming, I'm just assuming. Assuming OTC currency options are available, and let's assume traded currency options are also available. Both are available. Now my question is, if OTC currency options they are available and tradable currency options are also available, which one company will choose and why? Please answer. Which option company will choose and why? I need a really good and conceptual answer. If both the options are available, which one company will choose and why? Please. Both the options are available. Which one company will choose and why? Please. I need the answer and let's see who has given the answer. Traded options because they are, yes, excellent answer. Company will go for a tradable options. That's an excellent answer because no. Liquidity is no. What do you mean by there's a liquidity? This is not an acceptable answer. What do you mean by liquidity? Can you explain that? The best answer is traded because they are less expensive. Now listen carefully, students. OTC option will be expensive than tradable options. Why? Because something which is tailor-made for me, that will be expensive. And something which is tradable, it is tradable for everyone. So it means premium will be higher in case of OTC option and premium will be lower in case of tradable option. No, please don't say this. This is not an acceptable reason. Liquidity is not an acceptable reason. Why this? Can I say one thing? When we say option, when I'm doing hedging through options, so I don't have any obligation. I don't have any obligation. I have a right to exercise. And when I'm going to exercise that option, so can I say on exercising that option, I'll be dealing with the writer of the option? Yes or no? Students, when you will be exercising the option, the second party will be the writer of the option. Now the writer is the entire market. The writer is sitting in the market or writer is a bank. I don't mind. So I think the main reason is there. Is this clear to everyone? Why I will go for tradable options? Okay, that's great. That was a really good question. Okay. So student, forward contract, they are OTC products available from banks, and any product which is available from banks, there will be no under overhedge issue. Okay, now under forward contract, what happens? Actually, exchange rate becomes fixed for you. And in case of indirect code, you need to divide. In case of direct code, you have to multiply. That's it. But there is one possibility. What is that? Let's see. ABC company is a UK-based company. Payment $1 lakh in 3 months' time. Great. Spot rate dollar per pound is selling 1.72 plus minus 0.02. dollar, pound sterling. Annual interest rates. Okay. We have 10%, 8% required. ABC company wants to hedge by forward rate hedge, comma, you are required to calculate final payment by using forward rate hedge. Please, this is the data, okay? Little bit zoom out. Oh. I want everyone to please quickly solve this. I'm giving you 3 minutes to do that. And within 3 minutes, I'll prepare a black coffee for me. I love the black coffee, but please have in moderation, okay? Not too much. Okay, students, I hope you have taken out the answer. So can you please share the answers with me? What is the approach? Can I say first we'll be using the interest rate parity to calculate forward rate? Yes or no? Can I say first we'll be using the interest rate parity? Okay, great. Interest rate parity. Just to explain. Interest rate parity. Forward rate is equal to spot rate into 1 plus interest rate in country A divided by 1 plus interest rate in country B. Okay. How do we decide country A and country B? I think I mentioned many times. Just by looking at the exchange rate sign. Whatever examiner has given you in the numerator, that is country A. Whatever is given in the denominator, that is country B. Numerator, dollar. So it means interest rate country A. Denominator, interest rate country B. This is how we decide. Don't go into that much technicalities. Just focus only on one thing. What is the exchange rate sign which is given in the numerator? That is country A. The exchange rate sign which is given in the denominator, that is country B. Okay. 10% is for the whole year, but we just need a 3 months rate. 3 by 12. I think I'll be getting 2.5%. 3 by 12, I'll get 2%. So 3 months forward rate is equal to, now spot is very important. ABC company is a UK based company. Payment. I'll be working on buying rate. So basically, if I deduct 0.02 from here, I'll get 1.70. By adding, I'll get 1.74. So can I say for us, the relevant rate is 1.70. Is this clear to everyone? Because we are dealing with a payment scenario. So I'll be using buying rate in the interest rate parity to calculate 3 months forward rate. So we'll take 1.70 into, can I say 1.025 upon 1.02. Let's see what I'm getting. Students, please check. I'm getting 1.708. Okay, 3. Can you confirm? Yes or no? So simply in 3 months' time, by using forward rate, total payment in pound sterling, $1 lakh, 100,000 divided by 1.7083. Students, I'm getting 58,500 and make it 38. Please check, everyone. Are you having the same result? Different? Is there anything which you want me to explain you? Otherwise, we'll move to the new technique. Please, you have 1 minute. Students, okay, let's see. Understood. It is understood by everyone. One more thing, never forget that forward exchange contract is a derivative. In fact, other than money market hedge, whatever technique you will be using it, that is a derivative. And we know that derivative means which has the three characteristics. One, it derives its value from something. Something could be interest rate, exchange rate, share price, stock index, anything. Second, initially, no cost is involved or very little cost. And third, settlement will be in the future. In case of forward exchange contract, logically, you will be having a gain or loss. It depends on the exchange rate. Second, initially, there is no cost or very little cost. And third, settlement is not today, settlement will be in the future. All the characteristics of derivatives are met. That is why forward is a derivative. And you need to know this. Other than money market, hedge, all techniques are. There's one more non-hedging method or non-derivative method, that is lead payment, but that is not in AFM. Lead payment means payment in advance, that you have taken the loan today and you have made the payment. Only money market is non-derivative. Rest of all the techniques like forward, interest rate hedge, currency future, currency option, all are the derivatives. Why I'm saying this? Because in the past paper there was one question in which examiner mentioned in the requirement that solve the question by using two derivative products. And money market was also applicable in that question. It means that whoever used money market hedge in that question will not get any marks. Why? Because money market is a non-derivative technique and it was categorical. It was not written solve by using any two hedging methods. It was written do hedging by using two derivative products. So money market hedge is not a derivative product. I hope it is clear now. Let's go ahead. Just let's go to the second technique, money market hedge. Money market hedge payment. Actually, under money market hedge, when we'll be doing hedging for the payment means foreign exchange liability. And in this money market hedge, you have to do just one thing. For a foreign exchange liability, you have to create a foreign exchange asset. If you have created a foreign exchange asset, then hedging is done. How do we create a foreign exchange asset in case of money market hedge payment? It's very simple. Let me just tell you the steps. Logically, the step one is practically we take loan in the local currency. But after that, what do? We convert that loan which we have taken in the local currency, we convert that into a foreign currency. Then we deposit the foreign currency in a foreign exchange account. So we take the loan in local currency, then we convert that local currency to the foreign currency, and then actually we deposit the foreign currency. That's just excellent. But while solving this money market hedge payment, numerically, what do? Step one is amount. First step is amount should be deposited. Should be deposited. Assuming after 3 months, I have to make a payment of $1 lakh. I'm just assuming, okay? That after, let's say, 3 months, there will be a payment of $1 lakh. Now listen, if after 3 months there will be a payment of $1 lakh, so I can say this 100,000 is a future value. I will be depositing the present value of that future value. So what I'm going to do, 1 plus I percentage n upon 12. This I will be the foreign currency deposit rate. Foreign currency. Here actually what are we doing? We are just converting future value to the present value. Whatever comes, I'm just assuming, let's say it could be 95,000, 98, whatever it is. The first step is amount should be deposited. Step two, amount should be borrowed. Now, I'm just assuming, okay, please, that this is 94,000. Now we'll take 94,000. We will divide this by spot buying rate. Now try to understand. If you are dividing, it means the question is in indirect quote. Indirect quote, buying rate is the lower rate. Or there's a possibility that 94,000 and we are multiplying this by spot buying rate. If we are multiplying, it means that examiner has given the question to us in a direct quote. I'll take higher rate. Okay, and one more thing. Money market hedge, you are doing hedging for the payment. You will be using a buying rate. Payment, use buying rate. Payment, use buying rate. I'm assuming I'm getting here 50,000 pound sterling. Let's say pound sterling is my local currency. Now what happens? After 3 months, the $94,000 which we have deposited today, they will become $1 lakh. And from this foreign exchange account, I'll make the payment of $1 lakh. But after that, I have to make the payment of loan to the bank. I will go to the local bank and I'll pay the loan of 50,000 pound plus I have to pay the interest as well. So just simply add the interest cost. 50,000 pound into I percentage n upon 12, I'm assuming it is 2,000 pound. So the total payment is 52,000 pound. The interpretation is within this 52,000 pound, company has made the payment of $1 lakh. Total payment. This I percentage will be local currency borrowing rate. This I percentage will be local currency borrowing rate. Okay, now let's see a question. ABC company is a USA based company. Required to pay 500,000 pesos in 3 months' time. Spot rate pesos per dollar 12.5 and 13. Pesos, dollar, annual interest rate 3 months borrowing rate 18% and 10%. 3 months deposit rate, let's say that is 15% and 8%. Required. Money market hedge. Students, I want everyone to solve this. I'm giving you guys 5 minutes. Please do it. Okay, sir. Let's do it together. Money market hedge payment. I'm just solving it quickly. You have to properly write it. Deposited amount. You have to write amount should be deposited. Instead of 500,000 pesos, you will be depositing the present value, okay, of that. Pesos deposit rate is 15% for the whole year. 3 by 12. I'm getting 3.75. Let me just check. Don't get confused with this 3 months rates because these rates are always annual. Look at this, annual interest rates. Logically, when I'm saying 3 months rate, it is a 3 months annualized rate. Bank does not give you directly a 3 months rate. Bank will always give you the 3 months annualized rate, 4 months annualized rate. So logically, the 3 months pesos deposit rate is 3.75%. So 1.0375. Let's see, what are we getting? 5 lakh divided by 1.0375. I'm getting pesos 4 lakh 81,928. Now amount should be borrowed. So borrowed amount. 4,81,928 indirect code, so I have to divide 12.5. Let's see how many dollars we are getting. 4,81,928 divided by 12.5. 38,554. Add interest cost. Dollars borrowing rate is 10%. With a rounding off, I'll get 964. 38,554 plus 964. Perfect. Everyone was having a correct answer. 39,580. Okay, now money market hedge receipts. Receipt means foreign exchange asset. For a foreign exchange asset under money market hedge, you need to create a foreign exchange liability. Step one, we take loan in the foreign currency. Step two, we convert that foreign currency to local currency and then we deposit the local currency. So what is the format? Money market hedge receipts. Step one is amount should be borrowed. Amount should be borrowed. Assuming we have to make the payment, we are having a receipt of $1,000 after 3 months. So I will borrow the present value of that future receipts. 1 plus I percentage n upon 12. This time I percentage will be a foreign currency borrowing rate. Foreign currency borrowing rate. Let's say I'm getting this, assuming $950. Now amount should be deposited. Amount. I'll take $950 divided by spot selling rate. Can I say if I'm dividing, it means examiner has given me the indirect code. Indirect code, higher rate. There's a possibility that I might be multiplying 950 with the spot selling rate. Multiply means examiner has given us a direct code. Can I say lower rate? I'm assuming I'm getting 600 pounds. Final step, this time there will be interest income. 600 pounds into I percentage n upon 12. Let's say I'm getting 40 pounds. Your total receipt is 640 pounds. Now this I percentage is local currency deposit rate. Local currency deposit rate. Now come here. This is part A, part B. Money market hedge receipt, assuming everything remains same, everything, but 5 lakh pesos is the receipts in 3 months time. So let me repeat. The question is same, everything is same, only one change. Earlier the 5 lakh pesos, they were the payment. Now I'm saying solve the question again by assuming that 500,000 pesos is your receipts. So 5 lakh is your receipts. Everything is same. Please, I'm giving you 5 minutes to solve this. Money market hedge, receipts. The first step is borrowed amount. Please, you have to write properly. 500,000 pesos. We have to borrow the present value of this. Pesos borrowing rate is 18%. For 3 months, let's see, it is 4.5%. So simply 5 lakh pesos divided by 1.045. 4,78,400 make it 69. Now, deposited amount. We'll be using the selling rate, okay? 4,78,469. 13. 4,78,469 divided by 13. Students, I'm getting dollar 36,805. Now simply add interest income. Dollars deposit rate. 8%. 36,805. Students, I'm getting 736. 36,805 plus 736. 37,541. This is your total receipts in dollars. Okay, now student. Today's class on risk management is not so long. What is the agenda for the coming class? That is very important. Basically, the coming class is going to be a grand live revision class, and it will be a very long class. Number one, it will not be a 2 hours class. Number one, you mentally prepared. What are the topics which we are going to cover? Remaining currency techniques with questions, plus interest rate hedges. And name of the questions, I will ask the admin to share by Monday. So in advance, you will be having the information, what number of questions and which questions we'll be discussing. But please be mentally prepared. Class is going to be really long. Really long means I would say the grand live revision class will be around approximately it will be, I would say, 5 hours. So number of questions, everything and will be shared in your WhatsApp groups. This will be the first grand live revision class on Forex, and after that we'll be having a grand live revision class on merger and acquisition. Is this clear to everyone, students? Can you please reply on that? Okay, one more thing regarding this. No, 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 no. Black coffee should be without sugar, okay? Don't have sugar is not good. Okay. So this is for agenda for the coming live revision, grand live revision class. Then inshallah, there will be a long class on merger and acquisition revision as well. One more thing. Now listen it carefully. Any question on Forex, any question on Forex, which is disturbing you, any question on Forex which is disturbing you, you can please just share the name of that question with me. So if it is very important, okay, Ammar has just mentioned one question. Actually, this question is already being discussed. I can do one thing. I'll upload the video on that question. If after watching the video still you have confusion, we can discuss. But again, I would request, please do mention the name of the questions with me, either in your WhatsApp group or private message, so that I can include those questions also in a coming grand live revision class. Is that clear to everyone? And we are conducting, I think yesterday I took a grand live revision class on SBR. So now I'm conducting grand live revision classes on every paper. In fact, I have reduced my other, I would say, engagement to give more time to my ACCA students. So now, inshallah, you'll be getting more time from me, inshallah. So I hope it is clear to everyone. So get ready for the coming grand live revision class on Forex. After that, it's going to be merger and acquisition. And then there will be a final grand live revision class. I'll tell you what exactly we'll be discussing in that class also, inshallah. So it's going to be really good. So thank you very much, students, that you have taken out time for today's class. Do give the feedback in your respective WhatsApp groups. Thank you very much.